In 2023, American credit card companies collected $130 billion in interest payments. Not revenue, interest from people who thought they were earning rewards. This is the story of how that happened, and how a small group of people learned how to turn the system around. On a Tuesday morning in September 1958, the residents of Fresno, California, opened their mailboxes and found something nobody had asked for: a credit card. 60,000 of them, mailed by Bank of America to households across the city. No application, no approval process, no one asking whether they wanted one. The cards were pre-activated, ready to use, with a credit limit already attached. The executive behind the experiment was Joseph Williams, and his theory was simple. If you gave people access to credit, convenient, frictionless, already in their hands, most of them would use it. And once they used it, many of them would not pay it back right away. They would pay the minimum. They would carry the balance, and the interest would come back to the bank every month. The card in the mailbox was not just a convenience, it was a hypothesis about human behavior, delivered to 60,000 households at once. The first year was a disaster. Fraud exploded, defaults climbed. Bank of America lost an estimated $8.8 million in the first 12 months. By any normal measure, the experiment had failed. But underneath the chaos, there was a signal the bank could not ignore. People used the cards. They carried balances, and the interest kept coming. The bank, AmeriCard, became Visa, and the experiment that lost millions in year one became the foundation of a $130 billion annual interest machine. Still running, still collecting. The credit card is one of the most carefully engineered financial products ever created, not engineered for your benefit, engineered for theirs, and the engineering is visible if you know where to look. Start with the minimum payment. It feels helpful. It feels flexible. It feels like the bank is giving you room. But the minimum payment exists for one reason: to keep the balance alive as long as possible. Take a $5,000 balance at 24% APR. If the minimum payment is around $100 a month, that balance can take more than 6 years to clear. Total interest paid, over $3,200. You borrowed $5,000. You repaid $8,200. That is not an accident. The minimum payment is not designed to get you out quickly. It is designed to keep you inside the machine. Then came rewards, cashback, points, miles, status. The framing changed. A debt product started feeling like a rebate program. Instead of thinking, I am borrowing money, people started thinking, I am earning points. And that shift mattered. MIT researchers once ran a study where people bid on tickets to sold-out sporting events. Half paid with cash, half paid with credit cards. The credit card group bid about twice as much. Same people, same tickets, different payment method. Credit creates distance from the pain of paying. The money does not feel like it is leaving right now. The reward feels immediate. The cost feels delayed. That is the trap. The points are visible. The interest hides in the background. And underneath all of it is the rate. Credit card APRs can run over 20%. Some cards charge close to 30%. At those rates, a small balance can become a long-term payment stream. The rewards are not free. They are funded by the people carrying balances. The cash back you earn is often paid for by the person who could not pay their statement in full last month. The system transfers money from the financially vulnerable to the financially disciplined. Inside credit card companies, there is an internal term for customers who never pay interest. They call them deadbeats. Not because they are irresponsible, because they are unprofitable. But the deadbeat is not just someone who pays in full. That is only level 1. Level 1? Never pay interest. If you carry a balance, you are not winning rewards. You are funding someone else's rewards. A 2% cashback card with a 24% APR balance is not a rewards card. It is debt with better marketing. So the rule is simple. Pay the statement balance in full, every month, no exceptions, and be clear on the language. The number that matters is the statement balance, not the minimum payment, not the current balance after today's purchases. The statement balance. Pay that in full by the due date and you avoid interest. Set autopay for the full statement balance, but still check the account. Autopay is a guardrail, not a substitute for paying attention. Once that rule is locked in, the card changes. It stops being debt. It becomes a rewards engine. That is where Level 2 starts. Level 2, earn flexible points. Cashback is simple. 1%, 2%, maybe 5% in a category. It is clean. It is easy. It is fine. But travel points are usually where the upside gets bigger, because a point is not always worth 1 cent. The beginner sees 75,000 points and thinks that is $750. The optimizer asks, where can these move? Can they transfer to an airline? Can they transfer to a hotel? Can normal spending become a trip I would never pay cash for? That is why flexible points matter. A trapped point has one path. A flexible point has options. It can become cash. It can move to airlines. It can move to hotels. It can be booked through a portal. And options are where the value is. But be honest about redemptions. Points, people love to say they got $5,000 of value from a business class flight. Sometimes they did, sometimes they did not. A $5,000 business class ticket is not really $5,000 of value if you would have bought a $600 economy ticket. That does not make the redemption bad. It just means you have to ask, what did this actually replace? Because if you exaggerate the value, you start chasing points for the feeling, not the math. Some people stop at level 2. They pay in full, they use one good cashback card or one flexible points card. They keep it simple, and that is still winning. Because the goal is not to become obsessed with credit cards. The goal is to stop letting credit cards profit from you. But if you want to become an optimizer, the next level is where the real upside starts. Level 3, win bonuses and categories. The biggest value is usually not in everyday spending. It is in the welcome bonus. A card might offer 60,000, 75,000, or 100,000 points after spending a certain amount in the first few months. That bonus can be worth hundreds in cash, or over 1,000 in travel, but only if you hit the requirement with spending you already planned. Rent, insurance, groceries, utilities, phone bill, business expenses, taxes, if the fee makes sense, a planned large purchase. The moment you buy things you do not need, just to earn the bonus, you are no longer winning the game. You are the game. Then comes category strategy. One card for dining, one card for groceries, one card for travel, one card for everything else. The point is not to carry 15 cards and turn your life into a spreadsheet. The point is to stop using one random card for everything. Same spending, different card, different outcome. But do not apply randomly. Every application can create a hard inquiry. Too many new accounts too fast can make you look risky. The optimizer is not opening cards out of excitement. They are spacing them out, tracking deadlines, tracking fees, tracking bonus requirements, and only applying when a card has a clear job. Level 4, use perks without worshiping them. This is where premium cards get confusing. A card with a $395, $550, or $695 annual fee can look insane. But the fee is not the real question. The real question is, what do you actually use? Travel credits can have value. Airport lounge access can have value. Global entry or TSA. Pre-check credits can have value. Rental car coverage, trip delay coverage, baggage delay coverage, and purchase protection can have value. No foreign transaction fees matter when you travel internationally. Otherwise, the bank can take a cut of every purchase abroad. But perks only count if they match your life. A lounge you never visit is not value. A hotel credit at a hotel you would never book is not value. A food delivery credit that makes you order more takeout is not value. A coupon is not savings if it changes your behavior. And read the terms. Benefits vary by card, issuer, and coverage rules. The optimizer does the math. Annual fee paid, credits used, protections used, rewards earned, redemptions booked. If the card gives more than it costs, it stays. If it does not, it gets downgraded. No emotion, no loyalty, No status attachment, because the card is not an identity, it is a tool. And one final rule before you start playing this game: do not close cards casually. This is where people make a quiet mistake. They pay off a card, they stop using it, then they close it. That sounds responsible, but it can hurt your credit score. Because your score does not just care whether you pay on time, it also cares how long your accounts have been open and how much of your total available credit you are using. When you close an old card, you can shorten your credit history and lower your total available credit. That can make your utilization look higher, even if your spending did not change. So if an old card has no annual fee, the better move is usually to keep it open. Put one small recurring charge on it, set autopay, let it age. If a card has an annual fee and the math no longer works, do not immediately close it. Call the issuer and ask if you can downgrade it to a no-fee version. That keeps the account alive, keeps the credit history, keeps the available credit, and removes the fee. That is the real game. Pay zero interest, pay the statement balance, earn flexible points, use the right card for the right category, take welcome bonuses only when the spending is natural. Redeem honestly, use perks you actually value. Read the terms, audit the annual fee, keep old, no-fee cards open when possible. Downgrade expensive cards before canceling. And never forget, the machine was built to make you slip. The bank does not need you to fail every month. It only needs you to fail long enough for the interest to erase every reward you ever earned. The question is not whether credit cards are good or bad. The question is whether your system is stronger than their marketing. The 30-day spending reset in the description is the first step to knowing which side of that equation you are currently on. Download it using the link below. Like and subscribe for more money stories. See you next time.